my name is Demi Edosomwan. First of all, thank you all for inviting me. Thanks to Nicholas and to Frederick for coordinating this. And so I work with Total Carbon Neutrality Ventures, as Nick earlier mentioned. And so we're the corporate venture arm of Total, the global energy company. And so we're not set up as a fund. We're actually investing off the balance sheet of Total. And it's is in line with Total's ambition, which is to achieve carbon neutrality by 2050. And so it's a $400 million fund. And so we have this bucket of funds to invest up to 2023. And we invest globally. So we have a team sitting in San Francisco as well, covering North America. And then from Paris, where most of the team sits, we cover the rest of the world. So we have an Asia team, we have also a Europe team, and I lead the emerging markets, which really is quite broad. We cover Africa, Latin America, and we also invest in India as well. And so in terms of our ticket sizes, we're investing as low as 200,000 up to about $10 million. And we have what we call a barbell strategy. So investing in very early stage opportunities as well as in a few late stage opportunities, just to balance the portfolio since it's an evergreen fund. But as we go on in discussion, happy to tell you more about our impact investment and how we screen opportunities. Thank you.
Thanks, that was wonderful. And now Joseph can go.
I guess I'm next. Okay, thank you for inviting me, Frederick and Nicholas. Happy to be here. Although I'm pretty lightweight when it comes to impact investing, because Burda Principal Investments, as what Nicholas mentioned, is set up more like a traditional venture fund with a focus on making a financial return from investments. Although, what is the best way to put it? Incidentally, we have invested in a couple of portfolio companies that have an social impact angle, which I can go into a bit later. In terms of our mandate, we focusing on Series B investments into consumer tech companies. I'm part of the Singapore office, and we cover Southeast Asia from here. We have two other offices, and one of them is in Munich and the other is in London. So yeah, let's get to it.
So I think that segues well into my next question, which I think the answer will probably be a little bit different for each one of you. So impact investing is a relatively new field. I think, back when I was in undergrad, it didn't even exist. If it had, I probably would have been very interested in it. And even though it is very new, it's become a very diversified area with a lot of different meanings when people say that they are doing impact investing. So the first question is, what is impact investing in your fund's perspective? And then given that you do have differing levels of focus on impact, how do you measure the impact of the investments that you make? And we can go in the same order as we did with the first question. So Sertac can start out.
Hi. Okay, let me start by saying that I think the sort of the gut reaction, the knee-jerk answer to this is that within the fund realm, if you're managing a fund, impact, because LPs define the fund as an impact investing fund, would like you to go into depth in terms of measuring impact using a number of different methodologies. So the easy answer is that yes, according to, we tend to take GIAN, IRIS Plus as a basis to measure impact, especially if you're in the equity space. And I think there are many other valid impact investing measurement methods. As far as I know, GIN did in its annual survey in June said that there are more than 15 to 20 almost different methods being utilized. So it's a very fragmented methodology landscape. And I think this is part of the reason that it sort of gets diluted in many cases, impact measurement. You do it at fund level, you do it at company level, but when you look at it in terms of systematic, how much impact is measured within companies, within funds that call themselves impact investors or impact investees, I think that's quite questionable. So, the answer to your question is that yes, measurement is commonly used among fund managers, but if you look at the landscape, much larger impact landscape, where I would put also in sustainable investments and responsible investments, because it's a big, large bucket, I think impact is measured relatively rarely, as suggested. So, you know, my call is that we need to have international standards in terms of measuring impact. We need to have standards for those who are calling themselves impact funds. We should have standards for those who are stepping into the game as impact players. Big names are coming into the play, you know, sort of the Black Rocks and the Apollos and KKRs with billions of dollars of you know, portfolios. They call themselves impact, and I'm just wondering how much of that is impact really investing. So you know, I think that I'll just stop here, and maybe other panelists would like to comment on this.
Sure. So Demi's from a large organization, Total. So I'd love to hear what your approach to measuring impact is, or I guess in your case, it's carbon neutrality. But how do you measure the impact you're making, and what does impact mean to you, I guess, was the second part of the question.
Okay. Well, maybe I start from the second part of the question, saying what does impact mean to us? And so maybe just continuing from where I left it, it was just to say that indeed we don't consider that impact investing is just simply determined by the type of sector that you invest in. And so impact itself is not defined by just the fact that I'm investing in certain areas. For us, we also look at certain elements as well. And so for us, it is key. Maybe I should emphasize at the beginning that, you know, when we talk about impact investing, we are not talking about concessionary investing. And so it is not in any way concessionary in terms of financial returns. In fact, we used to, because we used to be called Total Ventures, we used to call ourselves, you know, that we had a double bottom line. And so we're looking at the financial returns, and we're also looking at the social and economic impact. And then being rebranded recently as Total Carbon Neutrality Ventures to align with Total's carbon neutrality ambition, we then see ourselves having a triple filter. So we're also looking as well at the carbon neutrality angle. And so for us, the three are really intricately linked, and it's not, okay, maybe this is a high impact investment and therefore we can forgo returns, and, you know, it is philanthropic or concessionary in any manner. So I think that is really a core angle in terms of what impact investing is. I think the other angle which we look at as well is how do we measure the impact, which goes towards the second part of your question. And I think for us, I would say it's early stage as well. It's something that we're all still discovering. But again, I would say what we do is, first of all, we do make sure that the impact measurement is factored in even into our, I would say, due diligence process. And so while, you know, typically you're used to doing the normal due diligence on the market, the competitive landscape, the financials, we also do a review as well, an analysis of the baseline in terms of impact. And so it's not sufficient to say, for instance, you know, one of the cost segments that we invest in is energy access. It's not sufficient to say, of course, it's a high impact segment because you're providing access to people that have not had access to energy before, or to electricity before. But definitely for us, it's not sufficient that the segment is impactful. We are also looking deliberately at the impact that the company itself is creating. And I think another converse to that as well is also being conscious that the impacts are positive and not negative themselves. And so we're reviewing during our due diligence process the impact they're creating. And again, we're also looking strongly towards the work that GIN has done. GIN is the Global Impact Investment Network. And so they have, if you go on their website, you see also that they have a lot of material in there about, monitoring and evaluating impact. And one thing that Total has done is that, we have aligned ourselves very strongly with the SDGs, the Sustainable Development Goals. And so really when we are looking at impacts, we're looking at what are the main SDGs that are addressed by that particular startup, that particular solution that we're evaluating. And so it starts really from at the point of evaluation. And then, of course, once we invest, we know what the baseline is. And we also agree as part of the due diligence process, the impacts that we would like to monitor during the process. And so for us, we do tend to be light touch in the sense that, we're not a DFI, we also don't have LPs that we have to report to. And so what we try to do is we try to balance, our requirements for reporting with the needs of the startup. It's true that you find that, in terms of reporting impact, it tends to be quite rigorous to make sure that it's properly done. And it takes a lot of work on the part of the startups. And so we recognize this. And so what we do is that if we're co-investing with a DFI or, a strong impact investor who already has metrics which they've lined up, and sometimes some of those reports can enter into 10, 20 pages, the kind of reporting the startups need to do, we will typically align with that reporting, just so that we don't create additional work for the startup. If nothing has been done and we're investing very early stage, we will agree on 5 or 6 key metrics, and one of them usually will be carbon neutrality, that we will want, carbon emissions which are mitigated or avoided, which we'll be following. So we agree on a high level, like 6 metrics that we're going to monitor. And then that is what we'll request to the startup to report to us quarterly and annually on. And so really for us, it's really about those 3 angles, ensuring that, yes, we have the intention to create impact. And so it's not just we drift into it and we say, oh yeah, it's renewable energies and therefore it's impactful. The second is that we're not concessionary on financial returns. The third is that we are actually evaluating the impact right from the time of investment through to when the investment is done, and we're monitoring the portfolio company.
I guess it's my turn now as the non-impact investor, the black sheep. So sorry, using the word black sheep. But anyway, I think it's relatively easier for me. I don't have a double bottom line to manage. I just look for investments that make me money, like most other VCs do. So fairly straightforward. But to wind back a bit, to talk a bit about Burda's heritage and DNA. Burda, as some of you might know, it's a company with a very long history, all the way back to pre-World War, War I or War II, I think it's World War II. So it was started by Dr. Burda's mom, where she's a very strong lady who actually built up the company by herself, almost, right? So from that root, that carried on to today, where I think at the center of everything we do, be it investments, be it media, be it, getting into new markets or whatnot, diversity and inclusion is center at everything we do. And that is very important for us, even when we are making investments for financial return. So we consciously balance our team mix. We want to have female decision makers. So we actually have more female principals than male principals in our team as of today. We just recently promoted another female investment manager to principal. So that really helps us drive a more diverse perspective into how we assess investments. So an example to that is we invested in a company in Germany that's called the Female Company. So what this company does is they manufacture and distribute organic tampons in Germany. And because by virtue of them being in that space, they actually managed to lobby through pressure on social media, lobby the German government to abolish higher taxes on tampons. So the impact came somewhat accidentally. We did not really plan for it, but we liked the 2 female founders. We thought they were very passionate in what they believe in and what they wanted to do here, which is to create a product that the women really want to use, and in affordable and accessible way. So that was why we invested, but the impact came later on, and that was to us a very pleasant surprise. So there are many other examples like this to various degrees, but at least that's how we approach impact in our fund. On the flip side, when we look at certain exciting spaces that are getting a lot of investments recently, for example, peer-to-peer lending has been a hot space especially in Southeast Asia. There's a lot of numbers bandied around about underbanked and unbanked part of the population and how P2P lending can solve those problems. But when we look under the hood and we're like, looks like predatory lending. Maybe we'll stay away from it. So we also look to do no harm. I think those two guardrails actually then kind of put us partially in an impact investment kind of framework. It's not set in stone. It's not a rule, but it's kind of when I make this investment, I'm comfortable to go back and tell my kid that I invested in this company. So I think that's kind of what we live by. Hope that answers everyone's questions.
Yeah, and do no harm is definitely a good rule of thumb to follow. Just a quick follow-up to that, and I think all of you, especially Joseph and Demi, also spoke to this, but I was wondering, this is impact investing, it's not philanthropy, so there is a profit motive at the end of the day. So my question is there are there any heuristics that you follow that allow you to balance the two of those, making an impact and making a profit? And is it a case-by-case basis, or is there some sort of framework that you typically follow with the investments you make to make sure that they're both making a certain amount of impact and a certain amount of financial return? And Demi can start with this one.
Okay, thanks for that question. I think for us, it's definitely, as I said, it's not concessionary, and so it's really on the same footing. And I would say less on a case-by-case basis. It's really, it must meet the parameters in terms of both. It must be delivering impact. But what we've seen is that really there's a market for impact. So it doesn't mean that when you are investing in an impactful segment that you are conceding necessarily on financial returns. It's just that of course, you have to adjust your returns in terms of the risk for the country, for the market. But bottom line is that what we have found is that, yes, there is, and there must be a path to profitability. So when we screen investments, we're screening right from the get-go to say, hey, look, is there a path to profitability? And what is the impact that it's delivering? And so it's not, oh, it's very impactful, or yeah, it's going to address SDG 7, it's going to provide access to clean and affordable energy. Oh, by the way, it might not make us any money. It really is, side by side, we're doing the screening both, in line. And so any presentation we're making to our investment committee or to any management committee must contain an analysis of both the impact as well as the financial returns. And so, of course, it can be tricky, especially if you're going into, markets that are untapped, where there's no history in terms of venture capital. So it could be challenging. But what we found is that there is a real market. You do have, it's really the kind of where you have markets, for instance, for access to energy in Africa, for instance, more than 600 million people still do not have access to energy. So there is a market for that particular infrastructure to be put in place. It just really then is making sure that you're using the right solution, that it's frugal innovation, that it's something that is within the reach of the market, and therefore there is a path to profitability, and there's also a path to exit. So when we review an opportunity, it's not that we say, oh yeah, it's going to have great impact, or well, how do we make money? So for us, the exit story is also key right from the beginning. And so we're looking, what is the exit horizon? How long is it going to take? And is there a real exit? And believe me, when people tell me in emerging markets, especially in Africa, I'm going to IPO, we know that it's probably not the reality. And so really for us, we're concretely, who are the potential acquirers, or is there a path in terms of a private equity acquisition at some point in time down the line? So for us, it's rigorous, it's hand in hand. I would say it's, in some segments, we might consider maybe we have to then adjust the expectation of return, but at no point in time are we considering a return at all. It just might mean that where the case by case comes in is like, maybe for this segment, it's still, quite nascent, and therefore we might have to adjust the expectation. But I'll say that, yes, it's really hand in hand for both.
Great. So this is a bit shorter session than usual, so I think I'm going to just follow up with 2 final questions and have each one of you take a shot at it. But the next question I'm going to ask, which I think would be a good transition to what Demi just finished off with, is which sectors of impact investing do you see as being overlooked currently, and why do you think this is so? And I can have Joseph start out with this one.
Okay. At least from a non-impact focused investor point of view, I think one of the recent spaces that we looked into, and Frederick actually did this with us during his internship, his MBA summer internship with us. We looked into the food space. There's a lot of excitement downstream in the food delivery space. There's also a lot of excitement around B2B kind of marketplace models for food procurement. But as Frederick and I dived deeper into the space, we actually learned that the major problems are all upstream. Basically, the major problems are all with the smallholder farmers, right? So if we don't, if there are no companies willing to do the hard work of going all the way upstream to work together with farmers to make them more efficient, create higher yield, and solve a fundamental food problem that the world is facing, then everything that we invest downstream has is of less meaningful value. At least that's how we see it, and that's what we took away from our deep dive that we did together with Frederick. And thanks again for that, Frederick. So that is actually one space, the food sustainability phase. I think COVID has actually brought that to the fore because of the disruption in supply chains, but the problem has been there for a long time and it's been exacerbated because of population growth, and rising food prices, rising real estate costs, and all that, and also aging farming labor not being replaced by the next generation. The next generation is migrating to cities, hollowing out farmlands, and farmlands are increasingly getting controlled and consolidated under large food giants, for good and for bad. So all these are issues that I think are kind of not actively looked at by a lot of the companies that are actually in the food space. So at least that's from us.
Great. Sertac, do you see any other areas that are overlooked currently in impact investing?
Well, I wouldn't say overlooked, because I think, people are really keen on trying to find cases where you can actually do impact, do good, and at the same time generate financial gain. And this is impact investing is all about that, intentionally doing good while you're generating a financial gain. So as Demi said, if it's concessionary, then it's not impact investing in that sense, in many cases. You can call it some type of venture philanthropic activity, but essentially it's the impacts that investing definition is very much on financial gain hand in hand with social and environmental good. So what is actually being overlooked, and I think this is what's being overlooked, a lot of emphasis is being put on community-led development and almost pushing impact predominantly into an area where the impact investor invests in initiatives, entities, which actually do not build a big, I would say, scaling up capacity. I think what we need right now, if impact to make an impact in our world, in our lifetime, we really have to work on projects, initiatives, and big ideas that would actually change the way we live. And I think this is what's missing right now. Part of it is that there's limited capital to support scaling up. There's another issue which is sort of intangible, but there's a lack of imagination also to support any of the scaling up initiatives. There's a lot of grip by mainstream finance to push impact into a ghetto of some sort, defining impact investing just a sort of a long arm of economic development for communities. And there's nothing wrong about, and I think we should do everything to build communities, but the sum of the parts may be less than the whole. We need to look for ideas that leverage maybe technology, maybe other means, but ideas and initiatives that can scale up impact. And I think this is the missing link right now.
Great, and I will let Demi close it out with your thoughts on what you find to be overlooked in the space.
Okay, maybe just to touch on quickly a couple of segments, but potentially one will be clean cooking. A lot of people talk about energy access, providing solar home systems, but one area where we see that doesn't have, so much concentration in terms of investment is the area of clean cooking. And so while many people do know about the figure of more than 1 billion people globally not having access to electricity, less people do talk about the figure of 3 billion people that do not have access to clean cooking. And so a lot of people are still cooking with polluting fires, the charcoal, cooking over open wood fires. And this is causing more than 4 million deaths globally. And so it's one area, probably because, again, the profitability has not yet been proven. And it's really key to have profitability to be able to call it impact investing. So this is an area where still need to work more, as Sertac said, on innovation, making sure that we're able to then get the unit economics to make sense, just to be able to create access. I think another is sustainable mobility as well. So it's a hot topic, particularly in developed nations, but really looking at solutions that help to reduce carbon emissions from the way in which we transport ourselves on a day-to-day basis is really, really core, and something that I hope also will start to grab more attention in terms of impact investing.
Great. And unfortunately, this was due to scheduling issues. This was a shorter session. I know that there are a lot more questions I wanted to ask all of you.